What are currency futures? We understood in currency forwards that importers and exporters actually receive dollars and receive rupee payments whenever they made any deal with the bank. Over here on the currency futures, you actually don't exchange dollars or rupee. It's only a profit loss calculation that takes place. Let's try and understand how. Suppose if I'm an importer, I am supposed to import crude, which let's say today is costing me $1. And I see $1 today is 60 rupees. As an importer, I have a threat that $1.60 tomorrow, if becomes $1.65, I might have to pay 5 rupees more per dollar of my import. So what do I do? Currency futures are same like forwards, but the only difference is that the futures are traded on the exchange. In India, it is traded on NSE, MCX. Okay. So now if this is the given situation and my threat is that tomorrow rupee might depreciate and from $1.60 it might go to $1.65, I would rather go ahead and on the exchange buy dollars at $1.60. Now what happens is, let's assume like I was anticipating and the price actually goes up and $1 becomes 65. So because I had bought $1 at 60 and now $1 is 65, I make a profit of 5 rupees. Understand, in futures you actually don't have to deliver dollars or don't have to take rupees and vice versa, like we were doing in forwards, where the bank was actually giving dollars and the importer and the exporter were actually transacting and changing or exchanging the currency. Over here it's a pure profit and loss settlement. What I mean when I say it's a pure profit and loss settlement, I'm trying to say if $1.60 is what you bought the dollar at and tomorrow the dollar becomes 65, you make a 5 rupee profit. You actually don't have to buy it at 65 and sell it at 60 and all that. No, you bought it at 60, it became 65, you make a flat profit of $5. So what happens in this case is, now when $1 is 65, when I am doing $1 worth of import, how much will I have to pay? I'll have to pay 65 rupees. But what is the net cost to me? The net cost is 60 rupees is because I have made a profit of rupees 5 by trading in the futures. So I paid 65 from the person I imported to, but on the future contract I made 5 rupees. So what is the net for me? The net for me per dollar is 60 rupees. Similarly, let's assume if I am an exporter. So if I am an exporter and I have a risk that today when I'm exporting something on which I'm receiving $1, I'm actually getting 65 rupees. But tomorrow it might be a sound possibility that when I will export the same thing, but $1 is 60 rupees. So when I export something worth $1, I get only 60 in hand. So what should I go ahead and do? So on the futures, I will actually go ahead and sell dollars or buy rupee, means the same. So I sell a futures contract on NSE or MCX for dollar at 65. So when $1 becomes 60, I sold it at 65, I buy it back at 60, I make a profit of 5 rupees. So when I actually am to export something worth $1, how much will I receive? I'll receive only 60. But I've made 5 rupees profit on the exchange. Hence the net for me is 65. This is how people use the futures exchange to hedge their position. So the difference between forwards and futures is very simple. In forwards, assets actually change hands, which means if I am an importer and I would need dollars after a month, so I sign a forward contract with the bank where after a month bank actually gives me dollars at a rate which was predetermined. So in forwards, assets actually change hands, but in futures, it is cash settled. What do I mean when I say cash settled? I'm saying you bought dollars at $1 equal to 60 rupees. Tomorrow $1 becomes 65. Over here, no one gives you dollars, but because you bought at 60 and it went to 65, you are paid the remaining 5 rupees. That's the major difference between a forward and a future. Apart from the theoretical difference, which in the current context of the subject that we are learning is not important, whether forwards are non-standard contracts and futures are standard contracts. Forward contracts typically have less of third-party risk, third-party guarantee. Futures have no default risk. So that is more on the theoretical aspect which we don't need in the current context of what we're trying to study. So now that we've understood spot, now that we've understood forwards, now that we've understood futures, let's look at what are non-deliverable forwards. Non-deliverable forwards, also called as NDFs. Like the name suggests, this is a forward contract which is non-deliverable. Now why there is so much of confusion about it? So what's a non-deliverable forward contract? It exactly works like a futures, which is cash settled. We just learned that if I buy $1 at 60 rupees and tomorrow $1 becomes 65, I actually don't have to pay 60 rupees and I receive 65. It is cash settled. I directly get 5 rupees profit that I make. We learned this is how the futures contract operate. This is exactly how the non-deliverable forward contract operates. I buy it at 60. When it goes to 65, I make the 5 rupees, which is cash settled. Then why is it called non-deliverable forwards contract? It's called a forward contract because unlike a futures contract, which is exchange traded, so futures is traded on an exchange like we learned, the NSE MCX over here in India. Non-deliverable forward contracts or NDFs are traded over the counter like the forwards contract were traded with a bank. Okay, that's the major difference, which is why this is called a non-deliverable forwards, because it is over the counter traded. When you trade on the exchange, people who know a little bit of derivatives, they'll understand that you have to pay margin. You have to pay margin to trade the futures contract. Over here, you don't pay any margin to trade in the non-deliverable forwards contract. It is cash settled at expiry. Okay. Then why is non-deliverable forward contract becoming the buzzword for our currency problems? What is happening is an FII who's investing in India normally would want to hedge the currency position, and they hedge it by signing up a forward contract with the bank, for which they keep all the stocks or debt that they've purchased with the bank as collateral. Because FIIs or NRIs or anyone who is not an Indian resident is not allowed to trade in the futures market on our currency exchange. So if they want to hedge their position, they'll have to hedge their position only using the forwards market and probably with the bank because they are the biggest. So suppose if I'm an FII who's got $10 billion worth of holding of debt or commodity, debt or equity, I will go to the bank, I will sign a forward contract with the bank for $10 billion. Okay. And I'll have to keep the equity and debt with the bank as mortgage, for which the bank and FII, which is me, will sign a forward contract, which means I will buy dollars from the bank will sell me dollars, and we have to exchange our currency, let's say after a year. That's the forward contract between us. Okay, so I have bought dollars from the bank sold dollars to me, and the contract is for a year. Now what happens is, as an FII, I trade for myself, my clients, for P note holders. Okay. Now what happens is, I would want to hedge position for myself, which I do with the bank. But what I also do is that on behalf of my clients and my P note holders, also I go and hedge with the bank, which means I keep their equity and debt with the bank as collateral and hedge on behalf of them also, which the RBI thinks that the clients and the P note holders are not aware of, that the FII is hedging on behalf of them. Now, what will the FII do? That means for the client and for P note, in the forward contract, the FII has bought dollars from the bank, like over here, to hedge. Okay. Now, because they are not allowed to trade in the Indian market, they use the non-deliverable forward market, which trades in Dubai, Singapore, and Hong Kong, which means USD rupee is also trading on the non-deliverable forward market in Dubai, Singapore, and Hong Kong. Now, because rupee has been depreciating so much, you always had the non-deliverable forward trading at a premium to our Indian USD INR contract on our futures exchange. So what were the FIIs doing? The FIIs were actually buying dollars on behalf of the client and P note holders in India, which RBI thought that the clients and P note holders are unaware of. They have bought dollars in the Indian forward exchange, and they were selling dollars in the NDF in Singapore, Dubai, and Hong Kong, because NDF was trading at a premium to the Indian exchange because of huge rupee depreciation. This is how RBI is anticipating that FIIs were making arbitrage gains, and hence RBI came up with a rule saying that if FIIs want to hedge on behalf of the client and P note holders, they will have to have a written consent from the client and the P note holders that the client and the P note holder wants to hedge, only after which they'll be allowed to hedge. Now the question can be, why in the NDF market will we have the dollar trading at a premium? The answer is very simple to that. Indian markets, that is NSE or MCX, for currencies trade from 9 to 5. But if you look at a composite of Hong Kong, Singapore, and Dubai market, this will turn out to be a 24-hour market, which means that if people are negative on our currency, okay, it will reflect in the Indian market only between 9 to 5. What happens after 5 and up to 9 in the morning? So people would actually go ahead and buy dollars or sell rupee in Hong Kong, Singapore, and Dubai. So what happens is, when I as a trader in India look at the non-deliverable forward market where people have been buying dollars and selling rupee at 8 a.m., I see that the dollar is trading at a premium. Is because till 9 to 5 these markets were reflecting what the Indian markets were doing. But after 5, because the Indian market stopped, the activity was on only in these markets where people knew that the rupee is going to depreciate and dollar is going to go up. So people were buying dollars and selling rupee. So at 8 a.m. in the morning next day, before our market starts, me as a trader would definitely want to know what is the market expecting the dollar and the rupee to go. See? And I know that in the offshore markets in NDF, people have been buying dollar and selling rupee, and hence dollar is trading at a premium and rupee is not. Hence, when at 9 o'clock the market opens, I also start buying dollars in India. And this cycle continues, because of which you always had non-deliverable forward market where dollars were trading at a premium to the Indian markets, and hence an arbitrage gain could be made. I hope the NDF is absolutely clear.